Here. All right. Welcome all.
This time around, last time we didn't have that. We only went up by whatever information that we sent.
Welcome everybody to our roundtable on fraud. This is our Mortgage Quality and Compliance Committee's roundtable. I'm going to turn it over to the chair of the committee, Jeff Flory, who's going to get it going. Thank you, Jeff.
Wonderful. Thank you, Krys. Welcome, everyone. California MBA's Mortgage Quality and Compliance Committee's Roundtable. And today we are tackling a very nasty F word. And that's not FICO and the increasing cost of credit. It's not fallout and the soul-crushing blow of losing a loan so close to the finish line. It's all about fraud. And as our panel of experts will confirm, mortgage fraud isn't just a possibility, it's a probability. And today we're going to focus on what's happening in the market today. What are firms doing about finding it and rooting it out? And how do we collectively as an industry stay ahead of the schemes to minimize its impact on us? And before I get to the introductions, I do want to let you know that Krys Delk will be monitoring the chat box. I think we have you all muted, but we will be monitoring the chat box. So please, as questions pop up as we start this process, don't hesitate to throw your questions out. If we can insert them at the appropriate time, we will. And if not, then we'll send out answers to those questions after the actual panel is done. So with that being said, I want to introduce you to my panel, and I'm going to start this alphabetically. Start first of all with Adam Chaudry. Adam, you want to do a quick introduction of yourself and your firm?
Absolutely. Adam Chaudry, president of Funding Shield, based recently moved from Newport Beach to McLean, Virginia, but I'm back and forth quite a bit to our headquarters. We are in the business of wire fraud risk management as well as title fraud prevention. Been doing this now for about 8 years in the market, and we're excited to be very proud CMBA Presidential Council members.
Thanks, Adam. Moving on to my friend and former partner in crime at InterThinks and First American, Jim Gellasch.
Good afternoon, everybody. My name is Jim Gellasch. I'm with First American. I am on the data and analytics side of the company, which we're everything about data and also mortgage analytics. We offer a tool called Fraud Guard, which many of you are probably familiar with, but I'm looking forward to the panel. Thanks, Jeff.
Thanks, Jim. Mr. Ed Gerding, Consolidated Analytics, please introduce yourself.
Good day, everyone. My name is Ed Gerding with Consolidated Analytics. I'm the SVP over our Risk Solutions Department. We basically are a full-service, privately held mortgage services platform company that provides solutions across the real estate finance industry. We do things such as valuations, due diligence, risk management and compliance, fulfillment, consulting, business process outsourcing, and we do some asset management. Thanks for having me today.
Wonderful. Thanks, Ed. And last but most certainly not least, good friend Bob Simpson.
Good morning, everybody. I am with Daylight AML. I founded the company a couple of years ago. I do two things. I provide mortgage-centered anti-money laundering training, BSA compliance, and I do BSA audits, independent audits that my clients need. So fraud is my world.
Thanks, Bob. Appreciate you joining us. So as we get started here, this is really kind of a broad-based question, and I'm going to start off with Ed. When you hear the phrase mortgage fraud, what's the first thing that comes to your mind?
Well, when I hear that term, the first thing I think of, and I'm sure many others think of this also, there's a couple things. Number one is I'm kind of thinking about how many loans were impacted. I also think about what was the fraud scheme and what were kind of the elements of the perpetrated fraud. Then I start thinking about, who were the entities to the transaction that were potentially involved in the misrep. And then I really kind of defer in my mind to what were the control breakdowns. And last but not least, what is going to be the financial impact to the lending institution? And, basically, obviously, all of those things will be figured out once an investigation has been completed. But that is really what kind of comes to mind when I think about mortgage fraud, all the intricacies of what needs to occur and what has happened in that element of fraud that has occurred.
Well, so where do you see it happening the most? I mean, in kind of your experience, and I'll go to Jim next on this, but where are you seeing it happening most in the origination process?
Well, for right now, I would say really kind of obviously in the origination side of it, I see occupancy fraud, and I think we're going to talk about that a little bit later today, continuing to be problematic just because we've got housing affordability as an all-time low and interest rates are a little bit higher than we would love to have them. Obviously, we got a 25 basis point reduction yesterday. I don't think that's going to move the needle. Also, I think we have to be cognizant and diligent to combat geographic valuation risk, really in low housing inventory areas and declining markets. As you know, the collateral is really the most important component of the lending process, and so we need to make sure that the valuations are there. And last but not least, really kind of seeing things evolve over time. I think that there's a new era of mortgage lending and mortgage fraud just due to some of the new technologies and AI that's coming out there. And it really can be a double-edged sword. I think it can help the lenders from a preventative perspective on, finding those schemes and preventing it and detecting it, but it also could help the fraudster. So I think we just have to be on top of our game and use technologies and the AI better than the fraudsters.
Thank you. And Jim, what are your thoughts there? Because obviously you have one of the major fraud tools that's used by lenders in the marketplace. Where are you seeing it, and how have you seen it evolve? I mean, we worked together 11 years ago together at Interthings First American. How have you seen it evolve over time?
It's becoming much more intelligent. To Ed's point, all the tools in the marketplace do a great job. First of all, let me state that right out of the gate. They do a great job detecting fraud. However, fraud is kind of moving from what I'll call the paper trail world to the digital world. And fraudsters are becoming smarter, they're becoming more nimble. They're better at exploiting things, things like fake documents, very hard to detect. Back in our day, Jeff, it was pretty easy to tell if somebody fudged a VOE or a VOD. They usually couldn't even do the math right. So it was different world. But today, those documents are very hard to detect. You really need to leverage AI to dig into that stuff. Some of the things that we're seeing on the rise right now are, seller impersonation schemes where fraudsters are targeting vacant properties, non-owner occupied properties to pose as a seller to steal proceeds. Transaction frauds on the rise where, there's undisclosed agreements between the parties. Down payment manipulation, silent seconds, things like that are gaining traction. So, and then of course, with equity lending becoming very popular today, lots of schemes in the home equity world. I won't get into them now, but it's another area of concern.
I was almost going to say, I almost want to hear about it.
Well, again, synthetic identities where people are coming in, they're taking over, they're targeting people that have a lot of equity in their homes. They have open home equity lines that are not necessarily tapped, and they can come in and steal that money off of existing home equity lines.
So this is a totally random sidebar, Jim, and I've seen ads on various commercials for this title lock product, right? It's a title monitoring. What do you know anything about that, and what's that all about?
Well, working for a title company, that's a thing. I mean, that's always been a thing where people are going in and trying to steal a home. That's kind of what I was just talking about. Another way to do it, where you're filing a quick claim deed on a house and taking over the title, and then doing either trying to refinance it to steal equity out of it or to sell it. So that one's been around a while.
Yeah, no, for sure. And Adam, you're kind of on the last line of defense before that loan's funded. Why don't you talk a little bit about what you're seeing?
Yeah, so really our world in dealing with the closing it's a culmination of parties, right? So we don't get to sit in the silo, a lot like the title companies that, from Jim's perspective, when he speaks on behalf of First American, we have to think about a culmination of parties coming together that are part of that closing, whether it be the lender, the title company, the approved agents, any of the disbursement parties. as well as all the individual counties where you're kind of confirming and verifying enforceability of claim, and then also making sure that your communication with those agents is actually truly with those parties, right? So for us, the biggest thing, it kind of boils down to identity, digital identity and actual physical identity, whether it's a counterparty, it's a company, it's an individual on an email, and then also using source data as part of that journey to figure out how do I get closest to the source of the data to kind of validate my communication over email as with this party or not, or that this party is actually authorized to issue and conduct certain services, or truly is the owner of this bank account. And those things sound easy, but the simplest questions always have the hardest answers, especially in a world where all the technology that's out there from an AI perspective makes identity much harder to assess in every part of the process that everyone's talking about here. And especially when you're trying to figure out now at the closing table, where we call it the spot risk of the transactions, the transaction value, it's probably the biggest prize, and a lot of very elaborate schemes are put into place that are patient, observe, impersonate, and have the tools to now effectively communicate and use the likeness of individuals who are actually part of the transaction to impersonate these parties. So it really comes down to the perfect storms that we've seen have a multitude of layers of the fraud and a lot of intelligence with laymen behind them, like not really highly intelligent individuals behind them, because the tools are available to them.
Got it. Got it. Bob, you got any commentary there?
Well, all this conversation is great. It's the down in the weeds stuff of the particular frauds that are happening. If I can bring everybody's view up, sort of to the anti-money laundering aspect of this, I just want everybody listening to understand that internationally, real estate is like the prime way to commit fraud and to launder money. I mean, it's a big concern in every nation, and so, yeah, we have the little frauds here where somebody's lying about occupancy, but we also have the big stuff you guys are touching on, which is, hey, that's not a real borrower. That's not a real transfer. That's a washing of funds.
Yeah.
So the list, the array of crimes that can be committed here are from the sublime to the ridiculous. I mean, when you turn around and you just loaned on a property that doesn't really exist, that's way different than having loaned to somebody who's not occupying the property. So congratulations, all you QC people, all your special investigations units. You get it all. You see everything, and it can be, the solution can be as simple as recasting a loan, or it can be litigation in the FBI. So you guys get to deal with all of it. And yeah, it's like the world's greatest stories end up on your desk.
Yeah.
Was there a comment, an additional comment? No, Adam?
No, I would say that you bring up a good point, right? It's about prevention. And, I think the word and detection is such an important word in our space. But I think the game and the expectations from the places where you either have to capitalize that loss yourself or get insurance. And now the insurance market, I think I read an article last night that Chubb is now actually suing under its cybersecurity policy to fintech cybersecurity vendors that were supposed to be providing the services that didn't meet the threshold. So it's like they're now basically saying, look, I can't insure this risk. So the person who's supposed to detect it didn't adequately detect the risk. So there's really no insurance market for this. And so we always say there's no silver bullet. And to Bob's point, it's QC, but it's about where are you applying that QC in your workflow. And also fraud is also about intent. I don't think, the systems we see out there, like we don't really care about intent. There's got to be enough extrapolated value, and that's where technology really is the only way to do it, to capture it on all your loan flow and all your loan production.
No, great point. And Ed, you and I both provide, QC services, and you also do a lot of kind of deep dive kind of fraud reviews. So comment on the QC thing, because, there's obviously some QC folks on the phone today, and in identifying kind of where those risks are, what should they be looking for as they do QC? Because, you've got kind of a prescribed Fannie standard for QC, but then what do you do when you find those flags in there that there may be something wrong?
Yeah, obviously there's GSE requirements on the quality control side that everybody should be adhering to, right? And I think quality control is an integral part of your overall, kind of risk management approach and platform of making sure that, number one, you're looking at the loan manufacturing quality And a quality control defect can be indicative of some type of misrepresentation. So, when you see income calculations, be erroneous, assets not, gift funds not being documented appropriately, those things should show up in your quality control program. And ultimately, if they can't be resolved or they feel that there's a big enough red flag, they should be moving those over to the special investigations or the fraud investigations team. And that way you have a little bit more expertise on the fraud side of the house rather than just the quality component. And they can do a deep dive into the intricacies of that deal and really try to figure out exactly what happened and really who committed or what was committed. And obviously, they have the wherewithal to be working with local law enforcement and or the FBI, filing SARS with FinCEN, and making sure that the names of those fraudsters and or the entities of those fraudsters are getting visibly notable by the authorities, appropriately, so that hopefully they won't do that in the future. And obviously, there's going to be lessons learned on the quality control side and on the fraud investigation side. So, training is going to be optimal as well. And I always like to say, use real life examples. And I think we're going to talk a little bit, I'm going to talk a little bit later about a fraud scheme that my company investigated around the Baltimore, Maryland area. And basically what you want to do is you want to use those real life examples for your training so that folks know exactly kind of what's going on in the current environment. What are the elements of the perpetrated fraud? What are the red flags? So they can mitigate those going forward and hopefully minimize the loss to the industry and specifically their institution. And also too, if you don't have a strong fraud investigation team, there's reputational risk as well. You don't want to be looked at as like somebody that is not very risk averse or don't have the appropriate controls. So that's why it's just beneficial to spend the time and the resources that you need on a strong quality control program and on your fraud investigation so that you can minimize the impact to your institution.
Yep.
Let me point out one thing on the investigation piece of what you're saying, because yes, it is a specialized skill, and those who come into it new can sometimes be like babes in the woods. They don't quite know what to be suspicious of. I've had people I'm training say, "Oh, that guy wouldn't lie. He's a teacher, cop, fireman, whatever." No, he wouldn't lie. He's a pastor. Hang on, you can find fraud and misrep everywhere. And we live in this kind of weird world where in mortgages, so much of what we catch, thank heavens we have you on the front end with Fraud Guard to like catch the OFAC violations and do some screening, because it is. I'll do your ad for you. It's a very valuable tool. But so much of what we do in the mortgage world is the QC stuff, is people catching it, a little later down the line. Yep. If you're running a bank, you're going to do your scans to see if there's money laundering happening through your ATMs. That's cool. That's great. We got good automated tools. But man, so much of this in the mortgage industry is time on the water, experience, calluses. I've seen this. This stinks. Let's investigate this. And it just takes some time on the water to get those skills.
Yeah, to your point, what we were talking about last week, Bob, with the LLCs, we need to get better as an industry into being able to dig in that stuff and figure out who owns these companies. In a lot of cases, we're making loans to. So,
yep.
So here's a question that we didn't actually talk about, and I'll throw it out there and see who wants to grab it. But fraud schemes that happen, and there's kind of this lack of communication amongst lenders around sharing when we uncover a fraudster, be it a loan officer, be it a title company, or some sort of bad actor in place. What do you think we can do as an industry better to kind of collaborate on kind of drumming these bad players out of the market? And I realize we didn't talk about this question, so it's a little bit out there. But if anybody wants to tackle, Bob, I'll start with you.
Who's old enough to remember Mary, the Mortgage Asset Research Institute, Jim Cross?
Yeah, are you thinking we should bring that back, Bob? The bad list.
Jim was a good friend of mine, and he called me the day he sold Mary, and he didn't tell me how much the check was, but he said, "Bob, I don't need to worry anymore." It's an old idea of sharing information. Let me bring it into BSA. Under the Patriot Act, we have Section 314B, under which you lenders have got to respond to subpoenas in 14 days and produce docs. But there's also 314B, which says And unfortunately, it's voluntary between lenders. Are you going to contribute? Are you going to agree to share information back and forth with each other? I know a bunch of lenders who haven't opted into 314B. They don't want to throw their data around, willy-nilly to other lenders. I think that's a shame. I think people should, when requested by somebody else under 314B, share your docs, share what you got. That would be a good way to look what you're doing. You're sharing docs between the knowledgeable special investigations units at lenders to go, oh, we don't have 6 loans, we have 600. That kind of thing should be encouraged, that cooperation under 314B.
Yep, totally agree. And honestly, that kind of draws right into, what Ed was talking about earlier in terms of the work that Consolidated Analytics did in that Baltimore case. So Ed, why don't you talk a little bit about that? Kind of what went on there. What are some of the lessons learned from that episode?
Yeah, and there's probably several lenders on this call that have been impacted by the fraud event. So yes, Jeff, we recently worked with several lenders on loan level fraud reviews, and it was over 100 loans. Basically, there was a fraud scheme that was perpetrated on hundreds of loans and properties in the Baltimore, Maryland area. And really, what it was collusion amongst entities to the transaction, and that's really the hardest fraud to find when you have players that are basically in cahoots with each other. These transactions were primarily multifamily DSCR business purpose loans, so they're non-QM. And the scheme was basically perpetrated by a single borrower and his connected associates. And there were numerous LLCs and entities where he and others were the principal agents. There was also several other actors in the loan transaction. There was a single wholesale broker, a single appraisal company, a title company, a loan officer, and an underwriter. And the scheme impacted numerous lenders, hundreds of properties in the Baltimore, Maryland area, and many lenders have put the brakes on DSCR originations in that geographic proximity. Anytime when you have the same entities to the transaction on multiple transactions, it's a glaring red flag. And when there is collusion, it makes the fraud easier to commit. Now, there were a couple key things I wanted to just kind of throw out from a red flags perspective. You should be looking at deed transfers prior to the loan origination. We saw deed transfers recorded 60 to 180 days prior to the loan origination. LLCs were acting as both buyer and seller. And on every one of the transactions that we looked at, it wasn't the buyer and the sellers were only LLCs. So again, that's another kind of red flag. Obviously, you're going to have some of those peppered in there, especially on the business purpose lending side of the house. But really, every single transaction, that's unfathomable. There were questionable leases that were used to qualify borrowers. And then last but not least, there were really large unexplained jumps in property value. And that's kind of really where the monetary piece hits the rubber meets the road. And then those loans started to go into delinquency. And then they started the investigation. And then basically what ends up happening, any good fraud investigator is going to take loans and with similar attributes, and they're going to pull more into the investigation so that they can really understand what their exposure is. There was a couple lessons learned real quick, if I could. And one is you just need to make sure that you have policies and procedures and controls that don't allow the same entities on multiple transactions. That just is not common sense. And obviously, it could indicate potential collusion and perpetrate a fraud scheme. The other thing is, which was interesting to me, is a lender should have limits on the number of business purpose loans or dollar amount of the transactions. And typically what we see out there from a risk averse organization is limiting those investment properties to 10 or usually a $5 to $8 million threshold. The interesting thing is we do a lot of operational assessments on the agency and non-agency side. On the agency side, most of these lenders have that control in place. But what I have noticed on the business purpose lenders, there's some that do not, just because these are investors and a lot of them have a lot of experience in investing in, ground up construction, renovations, fix and flips. And so they're like, okay, these guys are investors. We've worked with them before. Let them have a bunch of loans because, we've got profit margins on those. But basically, that's a huge control. And some of these lenders found out the hard way because they did not have that dollar limitation or the property limitation. And one last thing that I will just comment on, and I talked about this earlier, you should basically be using these real live fraud schemes to train your staff so that they're aware of kind of what's going on and they can arm themselves and how to mitigate that risk going forward.
No, that's perfect. And Jim, I mean, obviously with fraud tools in the marketplace, they're a must-have from an origination perspective. And there's always the fraudsters always seem to be a step ahead. And so how do we look and think about ways that people might commit fraud? How do we get ahead of that curve? Obviously, there's sophisticated schemes. How do we get a handle on being at par or maybe even ahead of the fraudsters in terms of where they're going?
Jeff, that's a great question. I wish I had the 100% right answer for you on that one, but I think that you have to have a fraud tool in place. You have to have a process. So you have to use a tool. B, you have to stay up to date basically on the fraud schemes, what the fraudsters are doing, what's happening in the marketplace. And then to get to the next level, it's the AI thing. We're going to need to leverage AI within our fraud tools to be able to pick up on things that the human eye can't see. Specifically, we were talking about the fraudulent documents before, but also things like synthetic identity, stuff like that. It's very hard to detect with a lot of the fraud tools within their current state. Not to give a pitch for our product, but one of the things that we've done is we've been leveraging machine learning for a while. We built an AI-driven scoring model built into our product, which leverages, I think it's something like 8 million past alerts that have fired throughout our, what I'll call our fraud database, and we leverage that to pick up on patterns. What we call behavioral analytics, pattern matching, stuff like that to root stuff out. But I think we just need to continue to get smarter, and leveraging AI is going to be a huge part of it. So,
Well,
if I could just opine on that for a second, Jeff, I'm sorry.
No, go ahead.
Because we talked about, lenders aren't really sharing information on the fraud schemes and those types of things, and we do need to do a better job of that. But also, and I'll put a plug in for you, Jim, the fraud tools that we have out there in the industry, obviously Fraud Guard and the Drive from Data Verify and the formal CoreLogic's got a tool or whatever. The good thing about those tools, and to your point, you definitely have to have that in place and run it on every single transaction. But the good thing about on the back end of what those folks are doing, those vendors are doing, is they're aggregating a lot of data that goes through their systems. And I know a lot of them take those known fraud events and some of those data elements, and they use that to help kind of fine tune their algorithms, so to speak, right? So I think that's a benefit that we get out of that's where everybody kind of shares the data, and it comes out kind of masked a little bit in alerts and those types of things. But
it's anonymized. We call it consortium data.
Yeah.
So it's really connecting that consortium data. Another big thing is our feedback loops. If your fraud provider can get a relationship with the servicing aspect of your respective businesses and get actual, known events like early payment defaults, things like that. Those things are huge as well. When we can plug those events into the fraud model, it just helps immensely and help tune things. So.
Yeah, and I was going to say the same thing. That when you think about the frauds that we see, and a lot of the same loans that Consolidated was working on Baltimore, we were involved in the front end at the time of close because we had to make sure that there was accurate and valid title, and a lot of those transactions we flagged for our clients, saying, look, there's some inconsistencies here in terms of the named parties. The parties are coming through the title side relative to who you're expecting, or there's just relationship issues here that we think exist. And, that comes down to that business desire to want to close a loan that exists specifically maybe in that space that's not owner occupied, but it exists in every market, right? The motivation is to close, given the cost of origination, all the fees that go into just getting that lead in the door. And I think a big part of that is, how do you think about getting parties to opt in and participate more in kind of clearing up that layer of getting to the first party data? And that's a big challenge still, right? The preponderance of of using all the different tools to do a digital identity verification, linking of bank accounts, for instance, in the non-owner occupied space. It's pathetic how low it is in terms of using tools like Finicity or Plaid to kind of confirm bank account ownership. I mean, you can't do it. They still take self-attested statements, and half of the time they're not even looking at them. So things that are frontline defense mechanisms that need to be applied have to be applied transactionally. And I also think that another big part of this is it's great to pull all the data together to get a confluence of data and predictive analytics. But I think a lot of the old school underwriting metrics in terms of risk management are we have a part of our business is we look at several of the data elements in isolation. We can confirm and verify them independently. And I'm sure this is a lot like what Jim is doing in FraudGuard, the underlying data model and in the risk model. But then you bring them together. And it's important to do that too within the organization of our clients, because if they kind of have one person running the ball through too many layers of the steps, and a lot of times that person that's really pushing is a front office person who's obviously motivated to get the revenue generating aspect of the deal through so they can make their fees. They're also the one that's not on the hook. So it's important to make sure there are proper gates as well as a kind of consolidated view of the entirety of the loan from a risk perspective. So it's good to have gates and steps and say step 1 to step 2, then it's this person that takes over. But a lot of times the fraudsters know that too. They know how to play the steps involved to get the ball all the way from one end through all the gates to the other side because they know how to manipulate, alter, play it, adjust. And so it's important to take a consolidated view of the loan file too.
Adam, let me augment what you're saying there. I totally agree. For everybody listening to this who's managing the process, you are running QC or you've got responsibilities to manage your outfit. Just it's important to recognize the different mentality of everybody who's touching your loan files.
Yep.
Loan officers are bred to be charming. Your underwriters are bred to be positive and to approve loans and get them done. And your QC people are designed to pick threads and find the problems. You talk to your fraud people. If I see a Schedule C that just gives a perfect back end ratio, just perfect, now the loan works. Underwriters are going to go, isn't that beautiful? And I'm going to look and go, nah, that was engineered. Somebody just cooked that Schedule C up to make this work. And you can't manage this process unless you recognize the different mentality of everybody who's touching those loan files. And then outside of your organization, if you really got criminals involved, they know that and they're going to exploit those things. So if you're managing this process, just recognize you got different attitudes even in your own organization about that information.
It's a key point.
I have to say something. I don't know what you're talking about, but being charming, Bob. Come on, man. Look at 2 silver foxes in this call. Let's go.
But
I was going to add in the equity world, especially, we see a lot of financial institutions and lenders that don't even run a fraud tool on the front end of the process, mainly because of cost.
Yeah.
Because they're covering closing costs a lot of times in those transactions, but trust me, the fraudsters know that. that's a known gap in the industry.
No one can defend to me. No one can ever defend to me why many years ago lenders stopped running 4506Ts on everybody. We used to run them on everybody, and then we made a decision. Well, they're in the file. That's good enough. The 4506T is there. Good God, why are we not? You had the tool right there to stop all kinds of tax return fraud, and we just stopped running them. It was a weird, I don't know even if that's pro-origination. It was just a weird change of policy that they were in the file and hadn't been run.
Well, Bob, that was really there were different products that exacerbated that with the stated income and the stated income verified asset and all that type of stuff. So I think those products exacerbated that as well. But yeah, to your point, why would you not run the 4506T and get tax transcripts? It just did not make sense. And honestly, that was part of the collapse in the 2008 mortgage industry was a lot of that. There was a lot of straw buyer stuff going on, straw borrower, the use of stated income and just basically not verifying income and employment accurately. So
but the real crooks knew we stopped doing that. So these things that we do internally that show weakness, they're observed from the outside. They know what we're doing.
Absolutely.
Well, I know the correspondent lenders that are on this call, the aggregators, are probably getting a little indigestion over the 4506 issue because they've got their own problems there. But Bob, you brought up a point. Should a lender's focus be on the people? Because you talked about the different personas and what that means, or should they be focusing on kind of data and technology in their fraud kind of strategy?
You have to do both. And what I recommend when I'm counseling clients on this is, yeah, you have your fraud guard, you have the automated tools. I want to add something on fraud guard. I see many times that the reports are run, but they're run before you know the identity of your grantor of gifts. And if I'm going to have money laundering happen with gift funds, it's that person's money I got to check out. So if the fraud guard is run in the first week and the name of the grantor of the gift isn't known until week 4, sometimes we skip that. So make sure that you're checking out the grantor of your gift. The second thing is I encourage clients to have a Freaky Friday where every so often everybody gets together and talks about weird stuff they find in their files. You know, I got somebody here whose sole income is child support. Well, there was a scheme running in Southern California where the guys were cooking up fake child support orders to get people qualified for loans. Fannie caught it. They said, hey, you got to stop taking child support orders as sole income. They got caught because they started using court numbered cases that didn't apply to that county. So they got caught. But that kind of stuff you can find in a Freaky Friday where your underwriters are pulling stuff out and go, has anybody seen this? And, you know, that might also touch on if you got bunch of LLC sellers and buyers in this transaction. You may not know it till you get your people together. So it's a combo. It's tech and it's also talking.
I do have a Freaky Friday story for you, and it's not related to mortgage, but there are a couple of guys here in Southern California that actually just got popped for golf tee time fraud. Yep. They were basically signing up for tee times and reselling them on the market. They made like 700 grand over 2 years, and they only got caught because they didn't file their taxes. Anyway, Adam,
I saw that one too.
Let's not start a new fraud scheme, okay?
Yeah. Let me take notes. Wait,
was that a gift at closing?
Right.
Yeah.
But hey, Adam, so technology has certainly made the closing process faster.
Yeah.
But what do you see the biggest gaps in terms of protection?
Yeah, I think it comes back down to the first we talked about. It's identity. I think the distance between the parties, the kind of the E of everything is great in many respects. But I think, you know, Jim touched upon it earlier where you kind of said kind of confirming synthetic identities, yes, when it's an application, but now you're talking about remotely accepting applications and closing and notarization and all these other elements that, yeah, there are tools out there. There's the hold up the license. But if you think about what those systems are really drawing upon and validating against, they're not going against the DMV. They're going against the form of a license. And does it look like the typical form of a California resident ID? The technology that's really out there that connects the back end is kind of part to parcel of what Bob was talking about with 4506Ts, and it touches upon a sensitive, politicized subject about access to data, permission to share data, as well as who can control that data at a centralized level. So there's a lot of push for, you know, our federal entities or state level entities in control of that data, and should they or the consumer individually allow the permission to share that data? So now when you're asking this question, am I really working with this person? Is this their actual document? Is their bank account actually this item they sent to me or permission by linking through their email account from them? It all comes down to that consumer consent. So if you look at where the trend is in technology and spend and investment right now, it's not on just the actual fraud detection. It's on remediation. It's on the actual resolution. It's on case management. That's where the highest multiples are, because that's the hardest thing to actually achieve, is how you're going to deal with the problem once you found it. So great, you found me a problem. Now fix it for me, or tell me what to do, or do I stop? Is it worth the reputational risk to not give this loan or to not enter this business contract? That's where we're seeing technology today, because the tools are all out there on the bad guys' hands and the good guys' hands. It's orchestrating, and then to Bob's point, calibrating the tool, because I see so many times clients are like, oh, we purchased this new tool or this new technology. They have it as part of a workflow. Where does it sit in your waterfall of solutions? What are the insights that you're supposed to find, the markers that you're supposed to find, and how is your team supposed to enact upon them? They don't do that last 2-3 steps. They just put them out there and say, hey, we got this tool, and great. Like Bob said, you got a lot of keen, eager young folks or new folks that are new to fraud or new to fraud technology. Maybe they've been doing fraud forever, but now they've got a tool they're supposed to leverage. They're either not going to use it or they're going to use it wrong. So it's like about the concept of understanding how to use technology as part of a workflow. It's a new flow and process. It's not, I've been doing it and it's helping me. No, we have to understand it's a new process altogether and be trained on the process.
Wonderful. Bob, I want to go back to something that you brought up at the very beginning of the conversation, which is that real estate, not only here in the United States, but all over, is really a great vehicle for fraudulent activity. And I think you and I have talked about this before. You know, banks and credit unions seem to have more robust KYC, AML type programs. And IMBs, I would argue, don't have the same sort of level of intensity in terms of the reviews that they do. So what would you suggest that IMBs do, knowing that real estate is such such a vehicle for that kind of money laundering fraud? What do you think they should do better, differently from an AML perspective?
Well, let me start here that if something sneaks past the goalie, if you end up doing business with Pablo Escobar's nephew, it's going to be a really bad headline. And these things don't happen often. Everybody listening to this knows you don't get OFAC hits very often. But man, when you do, it's bad news, and it can show your weakness as an organization. So we decided in this administration a couple of months ago that we weren't going to require domestic corporations to file the beneficial ownership information reports. Well, some people said, good, it's one less thing I have to deal with. The rest of the world kind of record scratched on that. We were like, wait a minute. Beneficial owners is like the hot topic. If you're looking at the concerns of any financial intelligence unit all around the world, from Australia to the EU to Britain, we're trying to prevent around the world anonymous transfers of real estate. And we just took a position in this country, well, we're not playing. We're not going to force people to disclose their beneficial owners. Great. But that does nothing to relieve you at the banks, credit unions, and mortgage companies of your burden to not do business with the bad guys. So use the tools, use the automated tools, make sure you've checked buyers and sellers in your transactions. I'd be curious to know, because this is an honest question. Do people check where your cash out is going from? I honestly don't know. If you give $100,000 in cash out of a transaction, if it goes to an LLC, is that ending up on your OFAC checks? I'm asking. Do you check who gets your cash?
Has anybody got a thought there?
I can tell you on some, because of the wire fraud component, we're getting pulled in more from the identity of the recipient and confirming the identity. So it's a contemporary concept and discussion point that we're getting involved in on verification flows, is using the same tools that are used upfront in origination of a first, of a resi for a cash out kind of transaction or a debt consol play where there's some cash out component. And it's something that's becoming more interesting in the current market cycle because of where embedded equity is.
Let me argue that it's a good thing for the boards to consider, senior management boards of everybody listening. The idea that you ought to check where your money is going from. When I was reading consent orders, one huge bank got in trouble because they let $700 million in cash be taken out from ATMs in countries they don't do business in. That's just a boneheaded move right there. Somebody should have caught that. So I think it's a worthy conversation at the board level to say, do we have a policy internally about checking where our cash goes when we give cash out?
No, it's a good point. It's a good point. Jim, I want to get back to a point you made about AI in fraud detection. So, what role should AI be playing in helping to identify potential fraudulent activity? And we certainly know the ability to craft documents better, but what do you see there?
I think that I think the synthetic identity piece is a big one. It just AI has got to be able to pick up things that the traditional tools can't do today, that the human eye can't see, that we can't see through our analog processes, if you will. It's got to be able to recognize, to pinpoint where the true fraud really is. So the tools that are available on the market today, ours included, they've been around a long time. As I said, they all do a great job, but they're we've almost evolved into, this alert-based system where we're firing tons of alerts off. A lot of them are false positives. We need to eliminate that stuff, and we need to be able to drill down into that small percentage of loans that really matter, to where the fraud people need to focus their efforts. The fraud tool shouldn't be just a mechanism to clear alerts and pass it through the system, if you will. It's got to do more than that. It actually has to work and find the true fraud. And AI is what's going to help you do that and get there, make it more efficient. So our AI with our product eliminates false positives. It eliminates the number of alerts that fire. It allows you to streamline efficiency, but it also will drill you down into areas that you need to focus on. That small percentage of loans that are actually fraudulent. So,
right. Well, and being a QC and a due diligence firm, two different kind of data sets that you're dealing with there. How do you see the role of AI in kind of helping with the data management and detection process?
Well, I think it's, as you know, AI can analyze massive amounts of loan data and really provide. One of the things that we did on the fraud scheme is we dropped it into an AI mind map, and it gave us a visual depiction of all the entities to the transaction and their connections. So you can have all these one-off summaries on each of the loans that you review, but when you get AI to kind of put it together and put the puzzle together, and you get a visual depiction of it, it was very beneficial for us. And I think that I'm starting to learn more about AI myself. I think a lot of companies are as well. As I think we talked about previously, Fannie Mae announced that partnership with Palantir.
Mm-hmm.
And, basically they've got a lot of technology and AI companies. I think we're going to start to see more strategic relationships evolve as the AI usage evolves. And it can really only make us better. But again, I always do that with a grain of salt and say, the fraudsters know how to use that AI as well. But I see it being a significant tool in our toolbox kind of going forward. And I think we're really just scratching the surface right now on it.
Well, and you mentioned the Palantir thing, and it's certainly something to wonder about what they ultimately plan to do with it, because I don't think they've really shared a whole lot of details. But where do you see that partnership leading between Fannie and Palantir?
Well, as you know, they're a data analytics company, and they've often been associated with military intelligence previously. And what they've done is they've taken some products and they've expanded their applications into corporate America. And obviously, the banking system, I'm not totally familiar with the company and any of the other verticals that they may be operating in. But what they do is they basically provide tools for data analysis and decision making. And AI is just one of the components of that. And their focus is really to enable organizations to leverage the data effectively. And again, ultimately, I think it's only going to improve Fannie Mae's capabilities and bring value to the organization. And I think we'll see that value add component when these other strategic partnerships start to crop up with other entities in the playground that we play.
Can I add a quick thought on there? It
Yeah,
is
please do.
so powerful. Let me make a couple of observations. Recently, Bill Pulte has been in the news for making some accusations about this. Palantir has the ability to find so much stuff. Would Pulte have said anything at all if he'd known that the AI was going to find Bessent's and his parents' problems with the same occupancy issue? And
Yeah.
and imagine your life if you think life is normal on a Monday morning and you go into your office and at 2 o'clock in the afternoon you find out that in your book of business you have 272 loans with occupancy problems. That's going to change your work week. It's going to change the next couple months of your life. There's so much of this sleeping dog kind of thing with occupancy that I think if you're really going to throw Palantir at finding somebody who claimed 2 homestead exemptions in different states, and I think they'd be able to do it because that's public, right?
Yeah.
So if they're going to find it, then this industry has a real big question. Do we do something about those loans, or do we let that sleeping dog lie? And that may be where we're headed. Very interesting.
Or a third, do we accept the reality that a lot of people do have different now ways of making income, multiple homes, right?
Yep.
And do we just take some of those requirements out there and then push collectively as an industry and say, look, this is such a pervasive issue, whether it's 0.001% or maybe a couple of zeros less or on the back end of it, we don't know. But if it's that big, at some point you basically have to say, well, now here's the new mu. This is all normal now. So
So you're saying we turn fraud detection into the spirit of the law as opposed to the letter of the law?
as an economist would say, mean reversion. So, but no, there's a new mean, right? So we have a new accepted standard for occupancy. Who knows, right? So,
Well, occupancy fraud is, and we talked about it earlier, transactional fraud is probably the most common and one of the hardest to really identify, because that's really where someone's just misrepresenting or omitting information and they have an intent to deceive based on fraud for housing or fraud for profit. And, on the occupancy side of the house, there's probably a lot of loans where occupancy has been misrepresented and they intend to pay, and they do. And those loans are performing and they don't go into a delinquent status. And, there's transactional fraud that is a performing asset. Obviously, it becomes a problem when, the delinquency crops up and then you start diving into it. But it's transactional in nature, and I think there's probably a lot of unknowns out there that we really haven't put a dollar amount to, just because the assets are performing.
Yep.
I've had servicers tell me they don't even want to know unless it becomes a problem.
Yep.
So
Yeah.
Wouldn't you love some data? What's between the time of closing and the time of listing on Airbnb? How many days? How many days?
Yeah.
Are they listed the next day? Did they wait a week? I mean, I think it's bigger than we think it is, and I think a lot of Airbnb got financed that way. It's just my gut.
Right.
Well, that one's a data set that's available for refis that I'm sure most of the major lenders are leveraging that, or most of the major providers in the fraud space are leveraging that data set now. I know we are, so we can catch it on the front end on a refi, but intent is a different issue. That's
right. Well, hey, we're sitting with about 8 minutes to go, so want to get close to kind of wrapping this up. And in times of turmoil, which we've had over the past couple of years, certainly there was certainly an increase in fraud risk, right? Because loan officers out there, they still got to make their Tesla payments, et cetera. And so there's probably a higher propensity for those charming LOs to play a little more in the charcoal playground in terms of loan originations. But where do you see it going in the next few years? Do you think it's going to increase, decrease, and why? Ed, I'll start with you.
Well, I think, again, and there's some solution providers out there that do some fraud reports. And I recently was reading the Cotality one, which was previously CoreLogic. And, what they're saying is in 2025, there's been a slight increase in fraud risk. It's relatively static, but it's been slight. I think in this environment, as I had talked about earlier, where you have higher interest rates and you have low housing affordability, fraud is going to continue to be problematic in those fraud schemes that are correlated to that. Once interest rates go down, there's going to be new schemes. That's what they do. They're basically chameleons, and they change with the times, and they will find new ways and new patterns to exploit. And so we just all need to be very due diligent in understanding how the market changes and how our policies and our controls should change to mitigate that, for sure.
Got it. Jim, I'll turn to you.
I would say, stay on top of the fraud trends that are happening. Use a fraud tool. Follow what the GSEs are doing. Follow their guidance and continue to train your staffs, train your people. Be on, ever diligent and stay up to date on what's going on.
Thank you, Adam.
I think there's
parting remarks.
Yeah, I think it's going to be increased challenges around cyber and data and identity. Coupled with more control by the actual parties who should be incentivized to opt into sharing their data and kind of figure out how to manage that paradigm, because they're not necessarily in the same wavelength. They don't really intersect all the time, and that technology is going to have to quickly become available to solve the fraud problem. And it's out there. It's a lot like what we mentioned from Ed. It's with the government and it's with other agencies that have access to it because they can control the use of it. And it's about how do you democratize that and privatize it in a thoughtful way without opening it up to, again, the bad guys.
Right. And Bob?
I think the advice I would give is to get really good with metrics, analyze your own risks, what kind of products you guys are originating and where those risks might come from. Is it builder business? Is it refi? Is it purchase? And then get in and love your metrics. Find aberrations in your data. Some broker somewhere with huge origination numbers, they might be new to you. Check that stuff. So decide what metrics would worry you, and then follow and measure those metrics every single month.
No, wonderful, wonderful. Well, I would like to issue my hearty thanks to Adam, Bob, Jim, and Ed for spending an hour with us. Great conversation. Thank you very much. Don't forget. Well, actually, I'm not going to steal Krys's thunder. I'm going to turn it over to Krys because she's got some CMBA business that she wants to talk before we let y'all go. So, Krys, I'll turn it over to you.
Thank you so much for being here for this roundtable. We really appreciate your time and attention to it. I put a link in the chat for our Legal Issues and Regulatory Compliance Conference, which is coming up on December 8th and 9th at the Irvine Marriott. If you enjoyed this, there's going to be lots of other wonderful conversations like this there, including an AI panel. So if AI is your jam, that will be there. Lots of other legal issues and regulatory issues will be talked there. Please join us. We have lots of sponsorship opportunities available. And if you'd like to maybe speak and join us there on stage, please reach out to me. If you're interested in, well, you are a member. So thank you for being a member. We appreciate it. And membership dues will be coming out starting next week. So please stay with us and join us. We have lots of exciting new membership things coming up next year. And we have 2 networking events, which will be coming up in November. So I hope to see you there, one in Santa Ana and one in San Diego. So I hope to see you soon. Take care. And if ever you need anything, please reach out to me. I'm always available. And everyone is saying thank you. And if you have questions, please email them to me and I'll make sure they get to the right person. Take care and happy spooky season.
Thank you all.
Thank you all. Have a great
Thanks.
afternoon.
Fridays.
Bye now.
Thank you. Bye-bye.
Bye.